Hello there, this is Bruce at Fleet Capital Management. It's Friday afternoon, the 7th day of March 2025. The week is over. Good. It was a tough week. We're going to take a look at some things that happened in the market, and I'm also going to show you a new investment that I have just begun using. I want you to understand how it works. It's interesting, but it's different, so we'll need to pay attention to that. We always start by saying that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You know I'm always available, Bruce at Fleet Capital Management. Right now, for the near future, our primary objective must be downside protection because we really don't know what's going to happen with the market. No one does. We can give some educated guesses based on technical analysis, but from day to day, it seems like the Trump policy tariffs change. One day he puts the tariffs in, the next day he delays them for a month. And then the next day he puts some back in, and then he does a delay. And then it's absolute insanity. Not my opinion, but if you listen to business owners around the entire world, they're saying, how can this happen? How can we have a change in such an important policy from day to day to day to day? How are we supposed to run our businesses? So, and I agree with that. One of the reasons I thought that the market might go up today, and it did, was because I've been watching this fear and greed index. And whenever we get into this level of retail investor fear, especially if we get down further down here, generally means to me the market might be looking for a short-term bottom. And that's exactly what seems to be taking place. I'll show you a little bit more of that when we get to the chart. This is the S&P 500, and this is not a normal chart. This is called a detrended seasonality chart. But the reason I bring this up is what it shows is February does tend to be a weak time for the S&P 500, and the bottom generally happens sometime in March. Even if I go out here, I don't know what this exact date is, but I would be looking for kind of a somewhat of a bottom, and then barring any changes from the White House, which is laughable, we could see a pretty strong rally from about the third week, middle of the third week of March and into April. So just wanted to show that to you. There are some ETFs that I own in most portfolios, not all, but most portfolios. And those three ETFs are gold, the symbol is GLD, XLP, which is consumer staples, the things that we have to buy, to live our lives. And then XLV is healthcare. Again, something that is somewhat recession proof. And I wanted to show you on this chart. It looks like it's a mess, but I'll show it to you. I wanted to show you how those three specific ETFs performed in 2022, which was a bear market. If you come down to the very bottom, this red line down here, this is the S&P 500 for that bear market in 2022. Okay. And these three lines represent the red is the XLV, the green is the XLP, and the blue is gold. And you can see they all didn't make a lot of money, but they certainly didn't lose money during. So these are considered defensive types of securities. And I just wanted to show this to you. I'm not suggesting we're going into another bear market. We could, and I'm going to show you the charts in a minute. But even if we have some bounces, these should do fairly well. So I wanted to show you why I have those three securities in there, and especially gold. It's not just a defensive, but it's also a hedge against inflation, which could happen very easily if these tariffs go into play, stay in play. Who knows what they're going to do? Let's spend a few minutes talking about a new investment that I have just begun using. The symbol is BALT. And what this is, You're probably already familiar with defined outcome ETFs, and the ones that I have purchased for you have generally speaking had a 1 year investment outcome, and the only day that really matters is that last day, the day of maturity. We've all talked about that. Balt, this is based on the S&P 500, has a 3 month outcome period. Okay. And it has 1-to-1 upside. So if the S&P goes up, this should go up with it, but it has a cap, which I'll show you. And then it has a 20% buffer. That is 20% over a 3 month period. So I looked back, I'll show you some stats on this, but I looked back and we haven't had very many quarters where the S&P was down 20%, but I'll show that to you. This type of investment that I have just put some in many accounts from group one and two can be used as a bond complement or replacement for people who are just in 100% bonds and are looking to potentially add a little bit more growth to their portfolio. We have a lot of money in cash, and it can be used as a substitute to a degree for cash management. And it can also be used as equity exposure, stock exposure for risk adverse clients. Well, you may not be a risk adverse client, but I'm a risk adverse manager right now because no one knows what the hell's going on in the market because of the uncertainty. So this is a new type of investment. The neat thing about this investment, I'm going to show you a few more slides, is that let's say we make a profit over the 3 months, that locks in and then rolls over to the new 3 months. So it's like a high watermark. We keep locking in profits. As opposed to if we're in a 1 year program and we have profits, they can also go down and then back up. We have a lot more time for volatility. So this is much shorter. So I did a little research and I looked at that over the last 25 years, the S&P 500 has experienced quarterly declines of 20% or more very rarely. Historical data suggests that 20% drops in the S&P 500 occur approximately once or twice within a 5 year period. So it's pretty rare. But these declines are not typically concentrated within a single quarter. For example, first quarter of 2020, the index fell by 19.6%, which is close to that threshold, but not quite. Now, let me stop here for a second. Let's say we were using this investment in the first quarter of 2020 and the index fell by 19.6%. What would our rate of return be for that 3 months? It would be zero because we're protected down 20%. Okay, make sense? Based on this frequency, it can be estimated that such significant quarterly declines have occurred in less than 10% of all quarters over the last 25 years. So that's great. That's what we want to know because this investment protects 20% on the downside over any 3 month period. And what you can see is it's pretty darn rare that a quarter for the S&P 500 goes down more than 20% for an entire quarter. So I think the risk reward potential is really strong. Now, this is a very interesting chart. This is basically showing, actually, I've got one more right after this that's even better. But this basically says if we're in a really bad market and the market goes down 20%, we have no loss. We have no loss because we are protected. This is over 3 months, anything down to 20%. If in the quarter it was down 22%, our loss would be 2%. Okay. If it's just a week, like what we're in now and the market's down 10%, we would have no loss. If the market goes up a little bit, our investment will go up and then it will lock at the end of the 3 months. We will lock in that gain and start anew. If we have an extremely strong market, we can only go up to the cap. And I'm going to show you that. But I wouldn't be using this investment in an extremely strong market. This is the wrong investment for that time. This is an investment for a sideways market that you can't figure out which way it's going. It's really not a good investment if we think we're going to have a prolonged bear market. It still could be good, but it's best in just a time of uncertainty. If you look at 2022, I think this was, yeah, 2022 was a bear market, okay? And in the first quarter, here's the S&P. The S&P was down 4.6. We were down basically nothing if we had owned this investment. The second quarter, the S&P was down 16%. We would have been down basically nothing. We've made no money so far, but we've also experienced no loss. The third quarter, it was down the market was down 4.9%. Again, we didn't make money, we didn't lose money. The fourth quarter, the S&P went up 7.6%, which gave us, we had been capped at that time at 3.2%. But here's the fascinating thing. If you look at your return for the year, this investment was up 2.6% and the S&P was down 18% because it's 0.00, 3.2%, and then net was 2.6%. So in a higher volatility or a choppy market or a period of uncertainty, this is why I went into this, because we might have some flat quarters and all we need is one positive quarter if the market's going down and we're going to outperform the market. And I think that that's very interesting. Here is, since I think this is August of 2021, the lighter blue line is the S&P 500. And then this darker gray line is this BALT. And what you can see the market went up, and then the very beginning of 2022 started this pretty huge downtrend, which was the bear market. But look at the volatility of this underlying investment. It was doing just fine. It did just fine. And then this came down again and it went back up. Now, then we went into a very strong market where here's the S&P. We're not going to go up anywhere near, but we're not going to use this investment in that type of a market. Hopefully that makes sense. When I bought this yesterday, before the protection hits, we were 40 basis points away. So this is the downside before that buffer was 40, okay? And we only have 25 days left, 24 now. But our remaining cap was 2%. So we have the possibility of making 2% in the next 25 days or losing 0.4%. And that's like a 5-to-1 reward to risk ratio. That is the type of ratio that I would take all day long. If I can make 5 times more than I can lose, that's a pretty great risk reward. And this is exactly what it was yesterday when I purchased this in lots of accounts. Okay, so I hope this makes sense. This is not an investment we'll use in a strong bull market. It may or may not be an investment we'll use in a strong bear market, but when there's uncertainty, this looks like a pretty fantastic investment to help us stay ahead of the game. Okay, so I know that was long, but I wanted you to understand that because that is now in your portfolio. When we go over to our matrix, it's not very good looking. The dailies are red. They've been red for quite some time. The weeklies have now both gone red. We have now changed colors once again into a correction, but when I show you the chart, you're going to see it's by like a penny. So that could change pretty quickly. Our bear market avoidance indicator, our primary one, is still up, but not by much. I'll show you that. And the entire week, the VIX has been over 20% or the 20 number. And what I've always told you, what Tom Bowley has always said is good things generally don't happen when the VIX is red or over 20. And that's what we're seeing in the markets. That's exactly what we're seeing in the markets. Go to our charts. So yesterday, this is the daily S&P on the left-hand side. I hope you can see down here is a red line. That is the 200-day moving average. And 1, 2, 3, 4. On Tuesday, the price intraday came down pretty much to that line and bounced up. The next day, at some point, the next day was a very positive day, but at some point of the day, it came down really close to that 200 and bounced back up. Yesterday, the price closed, if you see that little tick to the right, just above the 200-day moving average. That's why in my letter I said, I wouldn't be surprised if we see a bounce today, which we did. It dropped way below the 200, but then closed way above the 200. What does that mean? It means that so far, institutional investors are respecting the 200-day moving average. Um, they don't have to, but right now we don't have a close below the 200-day moving averages. We have an open, we have that it's been down below during the day. I don't care about those things. I care about the close. The close went right back up to this level here. So far, we're respecting that 200-day. Now, that's why I thought the market would probably go up today. And it did. No big deal. Does that change the trend that we're in? No. We had a nice update today. We had a nice update 2 days ago. We had a nice update 3 days before that. But that doesn't change the trend. The trend is down. And remember, I said we went into a correction. The blue line is the 20-day moving average. The gold line is the 50-day moving average. When the 20 crosses below the 50, that is considered a correction. And even no matter how much I blow it up, you will not be able to see it. But the 20 is below the 50 by about a penny. So maybe that turns back around and separates. Maybe it continues. I don't know. But that's too close for comfort. We are in a downtrend. And you always will have up days in a downtrend, and you will always have down days in an uptrend. That's normal. They're two different things. Okay. But our average volume is still red. Our OBV volume is still red. Our momentum is still down. And our RSI is still clearly below the 55 line. I use these three things. I use a lot of things to determine our trend and trend health. This would be momentum and volume. Those are the two most critical indicators that there are, in my opinion. But we're still downtrend. Now, to finish up on this, we have respected all week. We have respected the 200-day moving average. If we get a close below the 200-day moving average, that's a really bad sign. And if that happens on very high volume, that's a bad sign, and that would mean we're going lower. I don't know that that's going to happen. We're now going to have to wait until next week. If we come over here onto the weekly chart, our primary bear market avoidance indicator is this blue line, which is a 10-week moving average. Remember, each bar is 1 week. And the gold line is a 20-week moving average. If the 10 crosses the 20, let me take you back here. If the 10 crosses the 20, this will turn red. And that is our bear market avoidance. Now, does that mean we're in a bear market? No, it doesn't. It means I spoke with a guy in England who initially came up with this, and we spent some time on it. And what this is a early warning sign that a bear market could be imminent. Not that it is. And let me show you a perfect example. Back here in October of 23, the 10-week crossed below the 20-week. We had a couple of weeks of really strong down move, but then it crossed back up. Okay. And it's been up for a long time. So that can happen. But this is an excellent early warning indicator. When I did the studies on this, I looked back to see what happened with this just before we declared a bear market of 2022, and this had crossed. So this is more of an early warning sign, but it's a powerful early warning sign. Breaking and closing below the 200 is pretty powerful. The technical definition of a bear market is when the 50-day crosses below the 200-day. We're nowhere near that right now, but if you look at the slope of the line, they are sloping lower. And just none of that looks good right now. One last thing on this chart. Could we get a bounce? Could we get a bounce? Well, yes, we can always get a bounce. Let me draw my Fibonacci retracement and show you that today we had an up day. If we were to bounce and go up to somewhere around this 50 level or 618 level, still below the 50-day moving average, we could very easily then, this is called a pullback and a continuation. That could happen, and we would still be in a continuation of this downtrend. But we are in a downtrend until that changes, until everything changes and we're no longer in a downtrend. But what we do is we read our charts, we read what they say. We don't impose on our charts our will because the market couldn't care less what our will is. And right now things just don't look good. And that's why I have added that BALT. If we do get this response back up, doesn't mean the trend has changed, but we'll make money in this. And then depending on when it closes, we'll lock in some gains. So that's what we're trying to do. We're managing this very carefully because I think we have to, because the whole world order is a mess right now. Um, I'm not sure we have any allies right now. I mean, Europe is pretty angry at us and is stopping purchases of some of our farm products, and they're considering stopping other products. Canada is irate with us, and they have every right to be. Mexico is angry. Everybody's pretty angry at us right now. So my goal is to manage with the downside in mind. This is the primary objective. Do I want us to make money? Yeah, absolutely, I do. But our primary objective right now, because no one knows what's happening, is to protect the downside. And that's what I'm doing. So even the money that we have in cash is making a little over 4% a year. I think this BALT could make us some decent money over the year if we have some volatility in the market. Some of these other ETFs that I have purchased, gold and consumer staples and healthcare, could help us and we can make money on that. And I'm constantly, every day, looking for other ways to try to boost our rate of return in this very, very weak market. But I promise we don't have anything going on right now that's very aggressive. So that's a story. I know I went long. If you have any questions, please shoot me an email, hop on my calendar. Love to chat with you and see you face to face. And we can talk about it and we can make decisions together whether we should make adjustments in your portfolio. But I am erring towards full protection on the downside, nothing aggressive right now, and trying to make us as much as we can while there is this weakness in the market due to what's happening in politics and happening in Washington, D.C. So that's a story. Have a great weekend. I'll be back at this early Monday morning, and I will see you then. Bye bye.